The dollar wears an invisible crown, heavy and quiet, that most of the world has learned to bow to without ever seeing a coronation. What forced that crown onto a single currency? What bargains, threats, and midnight deals turned an American money-printing press into the plumbing of global trade? Stay with me. The answer sits between a president's televised words, an oil cartel's ledger, and a few confidential phone calls that rewired finance. It begins with a slow, practical desperation. In August 1971, a president looked at mounting deficits, a flood of dollars leaving American banks, and the shrinking pile of gold that was supposed to back those dollars. He did what modern finance calls a regime change. He closed the gold window, suspending convertibility of dollars into gold. That single act ended the post-war pact that had anchored currencies and opened the era of floating money. Imagine a merchant in 1971 counting coins by lamplight, and across a continent, a central bank governor realizing their reserve gold would no longer buy the same diplomatic calm. What happens when the anchor is cut loose? The next scene is an oil field at dusk. In 1973 and 1974, the world's price of crude blew up. Lines at gas stations, politics in emergency meetings, and rulers watching their bank accounts swell. Between 1974 and 1981, the current account surplus of OPEC members was roughly $450 billion, money that could not easily be spent inside tiny desert economies, and that needed a place to sit and work. This is the literal weight that pushed the dollar into a new role. How do you keep the world from collapsing into a cash shortage while also turning that cash into a steady market for your exports? The answer was less a single signed treaty and more a mosaic of leverage, incentives, and quiet guarantees. The United States offered security, arms, and political cover. Oil exporters found the U.S. dollar offered liquidity, deep markets, and treasuries, a safe harbor where windfalls could be invested. Over the next decade, that flow of oil revenues recycled through Western banks, funding projects, loans, and assets that glued the global financial system together. The term petrodollar recycling attempts to capture this huge circuit of money and influence. What did it mean, in practical terms, to have oil sold and saved in a single foreign currency? Picture a bank clerk in London, a sheaf of new deposits from Riyadh, landing like a sudden harvest on his desk. Those petrodollars went into syndicated loans, government bonds, and bank deposits. They financed highways in Africa, factories in Brazil, and interest payments in Europe. At home, American markets suddenly had a steady buyer for government debt, a backstop that lowered borrowing costs and magnified U.S. financial influence. But that was not free. It rewired who borrowed, who paid for oil shocks, and who controlled access to credit. There were human costs. The same IMF that watched the flows warned that the debts of 100 oil-importing developing countries rose by roughly 150% between 1973 and 1977 as they scrambled to pay higher oil bills and refinance through global banks. The recycled petrodollars softened a slump, but seeded longer-term balance sheet problems in the developing world. Who pays when an entire continent's credit lines are rewritten by a handful of banks and a single currency? There is a line from a finance minister in 1971 that sounds like something from a courtroom and a poker table at once. The dollar is our currency, but it's your problem. It was said in anger and warning, and it underlined the new asymmetry. The United States could run deficits that others would have to absorb. That remark captured the blunt reality that underpinned the era. If a currency's dominance is, in part, the rest of the world's problem to manage, What leverage does that give the currency's issuer? For a while, the system looked almost pragmatic. Oil sellers had buyers, U.S. treasuries had purchasers, and global trade had a common unit. But pragmatism carried a price. Dependence on a single currency concentrated risk. A dollar shock overseas could ripple back through credit lines, bonds, and commodity prices. Floating rates meant volatility. Political bargains meant that strategic decisions, where to station troops, which regimes to support, increasingly came with financial strings attached. The mid-1970s hold a small, human vignette that explains the tone. In a Beirut hotel lobby, a young Lebanese banker watches the phone light flicker with calls from European branches. Deposits from the Gulf are coming in faster than they can be lent. He thinks of lending to a state-owned company in Mexico and wonders if the borrower will weather an oil price shock. He accepts the loan. Years later, he will read about the debt crisis and recall the quiet decision to lend that night. Behind every headline, there are bankers and clerks making choices under pressure. Those choices add up to policy. What did those choices leave behind? The major reveal: the dollar's crown did not rest on oil alone. It rested on the combination of a fiat dollar, freed from gold, and a global supply of dollar-denominated payments that oil sales supplied. That double condition produced a kind of financial gravity, demand for dollars to settle trade, investment, and reserves. As a result, the dollar's share of official global foreign exchange reserves remained dominant. In 2024, disclosed figures show roughly 58% of allocated reserves in dollars. The crown stayed heavy, but not immutable. So if oil helped seat the dollar, what happens when states start to hedge away or accept alternatives? If this shift makes you look at your bank balance differently, hit subscribe, and we will keep pulling these threads apart. The story is more practical than dramatic, and it matters for what you hold and where. That mid-roll is small, direct, and earned because the next part ties the past to decisions today. Fast forward to modern markets and geopolitics. China pushes for trade in its currency. Regional blocs experiment with local clearing. Occasional headlines ask if the petrodollar is dead. The sober answer is that the petrodollar system evolved. It never was a single signed pact, and it never depended on oil alone. The 1970s bargains gave way to banking practices, deep capital markets, and institutional habits that are not easily unwound by one ruler or one policy. Yet the dynamics remain. Whoever controls the common unit of payment holds quiet leverage in diplomacy and crisis. Here are 3 clear takeaways to carry out of this episode. The first is practical, the second is structural, and the third is personal. First, the international role of a currency depends on deep markets and trust as much as on raw economics. Reserve status is not a prize you win once. Second, when trade and finance lock into a single currency, geopolitical power and financial plumbing become inseparable. Third, citizens and savers live through these bargains. Inflation, credit access, and fiscal choices touch ordinary ledgers, not just balance sheets. Think of the 1970s as an architectural shift. They laid plumbing that still moves money in 2025. That plumbing works until it does not. The warning is precise and not alarmist. Concentration breeds efficiency, and concentration breeds fragility. When a single currency sits at the center of global clearing, a policy shock in Washington can be a storm that reaches distant banks, crops, and pensions. We end with a caution and a question. The dollar's crown makes everyday trade smoother, and it also gives a few actors the power to shape the rules of the game. If history teaches us anything, it is that systems built for convenience leak power into politics. The next realignment will not be sudden like a single speech in 1971. It will be quiet, piecemeal, and decided in boardrooms and back rooms as much as in capitals. The rest of this story is already being written in ledgers and phone calls. If this shifted how you see history and money, join us, subscribe, and let's keep searching for the patterns they do not teach you in school. The next collapse is not a possibility. It is a mirror.